What if I told you you can pick the perfect company and still lose money? Stay with me until the end because most people never learn this about money. And understanding it could completely change how you invest forever. Before we dive in, quick question. Have you ever bought a stock just because it felt safe? Hit like if you have. And tell me in the comments what stock you trusted the most. A few years ago, a beginner investor did everything right. At least that's what he thought. He picked a company everyone knew. Strong brand, growing revenue, dominating its industry. Experts loved it. News channels praised it. It felt like a guaranteed win. So he invested his savings and waited. Months passed. The company kept performing well. Profits went up. The business expanded. But his investment barely moved. In fact, after a year, he was down. Confused, he asked himself, how can a great company give me bad results? That question changes everything. Because here's the truth most people miss. A great company is not always a great investment. And the reason comes down to something simple but powerful. Price. Stay with me until the end, because the last idea could completely change how you think about money. Let's break this down in the simplest way possible. Imagine buying a $10 coffee for $100. The coffee is amazing, best quality, perfect taste. But did you make a good deal? Of course not. That's exactly what happens in the stock market. You're not just buying a company, but you're buying it at a price, and sometimes that price is too high. When a stock becomes popular, everyone wants it. Demand goes up, price shoots up. But here's the problem. If expectations are already sky high, there's no room left for surprise. Even if the company performs well, it's not better than expected. And in the market, expectations matter more than reality. Let me explain this clearly. If investors expect a company to grow 30% and it grows 20%, that's still great growth, right? But the stock can fall because it didn't meet expectations. This is where most beginners lose money. They chase good companies but ignore valuation. They think, it's a strong company, I'll be safe. But safety doesn't come from the company alone. It comes from the price you pay. Here are the key lessons smart investors understand. First, price matters more than popularity. Just because everyone is buying doesn't mean it's a good deal. Second, expectations drive the market. Stocks don't move on what happened. They move on what was expected. Third, great businesses can be bad investments if you overpay for them. Fourth, patience beats hype. The best opportunities often come when others are fearful, not excited. And finally, investing is not about being right about the company. It's about being right about the price. Now here's the twist that most people never realize. The stock market doesn't reward you for finding great companies. It rewards you for finding mispriced ones. That means sometimes the best investment is not the most famous company, but the one everyone is ignoring. So next time you see a perfect stock, don't just ask, is this a great company? Ask, am I paying too much for it? Because that one question can save you years of frustration. If you found this valuable, subscribe to the channel for more simple, powerful investing insights. And if you want to become a smarter investor, watch the next video on your screen. Stay in touch for more information.